Roger Dodger heard he can take money out of his company without having to pay top-up tax if he enters into a Division 7A complying loan agreement. It's like borrowing money from a bank, so the loan needs to mirror arm's length terms and conditions. He goes and sees his accountant Mitch to learn more about it. Mitch says, "So, you need to pay interest and principal by the end of each year. The interest rate is set by the ATO each year, and it's currently 4.52% per annum. The loan term is a maximum of 7 years. So if you take out 700,000 as a loan, the principal and interest payments due by 30 June each year is around 118,000. Mitch produces this loan repayment schedule. So say in year 1, you have to pay $118,000, and that is made up of $87,000 in principal and about $32,000 in interest. And by the end of the year, your balance will be $612,000. Roger goes, "So every year I have to pay $118,000 to Dodger Co. Where am I going to get the cash? I would have already spent it on the boat. Can I roll it over into a new loan?" Mitch goes, "No, you need to pay $118,000. No, you can't roll it forward into a new loan because that would not be considered a real repayment, and so Div7A would capture it, and the amount that you haven't paid or the shortfall will be a deemed dividend." Roger goes, "Darn, I see. Can I capitalize the interest at least? Maybe pay it off at the end of 7 years?" Mitch goes, "No, you can't. Anything less than 118 will become a deemed dividend." Roger goes, Okay. "Can I get Dogeco to forgive the whole loan then?" Mitch goes, "No, debt forgiveness is also caught under Div7A. The whole thing will be a deemed dividend. Listen, Roger, most people just get the company to pay out a dividend to fund the minimum repayments." Roger goes, No dividends. I'll have to pay top-up tax, and you know how much I hate top-up tax." Mitch goes, "Yes, the dividend will be subject to top-up tax, but at least it's only top-up tax on 118,000 rather than the whole 700,000. That's like a difference between 29,000 versus 170,000 top-up tax." Roger goes, I see. So this allows me to take out 700,000 to buy my boat now, but I can spread out the top-up tax over 7 years. Mitch goes, "Yes, that's right. But so you know, there's still a tax cost. The interest to Dogeco is income, and so Dogeco has to pay tax on that interest income. And you have used the money to buy a boat. That's private in nature, so you can't claim a tax deduction for the interest paid to Dogeco. So effectively, the true cost of this complying loan agreement is the tax on the interest income, which is around 40,000 over 7 years." Roger goes, So that's an extra 40K in tax over 7 years to spread out top-up tax of 170,000 over 7 years. So I'm not actually getting away with Div7A at all. In fact, I'm paying more tax." Mitch goes, "Tax deferred is tax saved. Plus, you get to buy a boat tomorrow." While Roger absorbs this information, let's look at the rules in detail. Number 1, a Division 7A complying loan agreement must be made in writing between the lending company and the borrower. The maximum term is 7 years, and the minimum interest rate is the benchmark interest rate set by the ATO each year, which is currently at 4.52%. Number 2, minimum yearly repayments, which is the principal and interest payments, must be paid to the company by the end of each income year. They cannot be rolled into a new loan, nor can interest be capitalized into the loan. The minimum repayments can be paid via set-off against something that the company owes to the borrower. Most companies declare dividends to their shareholders so that the shareholders can meet their minimum repayments each year. Instead of paying out the dividend in cash, the dividend payable is set off against the minimum repayment owed to the company. Say Roger decides to enter into the complying loan agreement and Dodger Co. declares a dividend to him for him to meet his minimum repayments. Dodger Co.'s balance sheet would look like this. At the end of the first year of the complying loan, there's a loan receivable from Roger of $700,000 and interest receivable for the year of $32,000. Dodger Co. declares a dividend of $118,000 to Roger, and this remains outstanding as a dividend payable. The minimum repayment of $118,000, which is made up of principal of $87,000 and interest of $32,000, is set off against the dividend payable so that no cash needs to be transferred. This is all merely paperwork, which is what accountants are paid to do. Number 3, the loan cannot be forgiven by the company, otherwise the forgiven amount is a deemed dividend under Division 7A. Number 4, the company pays tax on the interest income, but the interest paid may not be deductible in the hands of the borrower, where the cash or the loan is used for private purposes. This is the tax cost or the tax leakage from entering into a Div 7A complying loan agreement for funding private lifestyles. If the cash was used to produce income, like buying an investment property, then the interest would be deductible in the hands of the borrower and there would be no tax leakage. Overall, the ultimate benefit of entering into a Div 7A complying loan agreement is that it allows cash to be taken out of the company now while spreading out the top-up tax over the next 7 years. I hope this video has shed some light on what Div 7A complying loan agreements are all about. Watch out for my next video on subtrust arrangements. Thank you so much for watching.